An injured Army veteran in North Carolina just got the Christmas blessing of a lifetime. U.S. Army First Sergeant John Mike Fairfax just received a full home makeover, plus his entire mortgage was paid off. It was all courtesy of the Tunnels to Towers Foundation as part of their mission to deliver 50 mortgage-free homes to heroes in the 24 days leading up to Christmas. Sergeant Fairfax was severely injured in an IED attack during his third deployment in Afghanistan in 2005. He is now working towards a Master of Divinity in preaching and pastoral ministry. And congratulations to him. And that's how Tunnel to Towers, or Tower to Tunnels works. It's really a fantastic charity. Now this, mortgage rates started the year right around 7%. Terrible. But today, well, okay, you can get a 30-year fixed rate mortgage for 6.18%. It's better. Katrina Campins joins me now. Katrina, when do you think we fall below that 6% level, and what kind of difference would that make to the market?
Thanks for having me today, Ashley. Last time I saw you, we were in Miami covering the real estate market.
That's right.
Well, mortgage rates are expected to dip lower in 2026, averaging around 6.3% on average, which is an improvement from recent peaks. Rates dipping below 6%, it's a question everybody's asking, will be temporary. While brief dips under 6% are possible, they won't be sustained due to the ongoing pressure from the Treasury yield and the bond market. We are in a higher for longer environment, meaning that structural factors like government debt levels and global bond demand are keeping long-term rates elevated, limiting how far mortgage rates can fall. Affordability will improve at the margins. Even modest rate declines can improve buying power and monthly payments, helping unlock sideline demand. We can expect market normalization in 2026, not a boom. And these rate levels point to a more balanced, normalized housing market rather than the return to the ultra low rate conditions of 2020, 2021. Yeah. And I have to say, Ashley, that timing matters more than perfection. So buyers waiting for dramatically lower rates may miss opportunities, as today's environment favors negotiation, price flexibility, and future refinancing potential. So in essence, short-term dips below 6% are possible, but staying there will require lower inflation, stable economic growth, and reduced bond market volatility.
I hear you. You know, home price growth is slowing down. 9 out of the 10 weakest markets for growth, believe it or not, are in Texas and Florida. Why is that?
So in many Florida and Texas cities, home values rose much faster than local incomes as out-of-state buyers flooded in when mortgage rates were near historic lows. As borrowing costs increased, that wave of demand faded rapidly. At the same time, housing supply expanded as homes built or purchased during the boom returned to the market, forcing sellers to compete for a smaller pool of buyers and reduce prices to close deals. In Florida, this shift reflects a market reset rather than a recession, a healthy rebalancing after unsustainable gains that is improving affordability, restoring equilibrium between buyers and sellers. Now, unlike past downturns, employment growth, population inflows, and long-term demand drivers remain intact, positioning Florida for more stable, sustainable growth once interest rates normalize. With that said, properties in Florida are still selling, and I can confirm that firsthand. I have many deals across Florida under contract. And I do believe, Ashley, that Florida's housing market is positioned for continued strength between 2026 and 2030, largely supported by sustained population growth and migration to the state. We're projected to see around 300,000 residents annually, which will keep demand elevated for both owner-occupied, I should say, and rental housing, even with shifting economic conditions.
Low taxes and beautiful beaches, that helps too. But I got 30 seconds, Katrina. Where are you seeing the most home price growth?
The Northeast and the Midwest, and we're seeing markets outside of New York City and Ohio. And like I mentioned, the Midwest, and it's because there wasn't a lot of building during that time, so there's less inventory in those markets, and there's still demand in those markets. And so we're seeing more appreciation in those markets as opposed to the South, for instance, where you saw huge gains, which now things are just equalizing. So that's the difference between the two markets now. that we're seeing. But
I hear you.
I'm very excited about 2026. I think we're going to have a reset in the housing market.
Excellent. I like to hear that. Katrina Campins, Merry Christmas and a Happy New Year to you. Thanks for joining us.
You too, Ashley. Thanks for having me.